What's up, guys? Brad here. Welcome back. Today I want to talk about 3 ways to grow your money faster than Warren Buffett. I know that title sounds so clickbaity. I'm even cringing a little bit, but it's actually true. Now, obviously you're not going to be making more money each year than Warren Buffett, but we can actually get a higher rate of return than Warren Buffett. Over the last 30 years, Warren Buffett with Berkshire Hathaway has averaged about a 12% annual return. So there's actually a couple ways that we can do better than 12% return with actually very little effort, very little thinking involved. So I want to share those with you guys. So let's jump right in. The first one is called the free lunch portfolio. Now, the guy who wrote this book, the Dando investor, Mohnish Pabrai, he wrote an article for Forbes where he came up with a strategy to kind of automate picking of stocks each year. And they back tested it from 2000 to 2017. And it achieved a return of 17.1% per year, as compared to the S&P 500 over that period, which was 5.4%. It was a tough time to be an index investor from 2000 to 2017. But you see the free lunch portfolio, it beat the S&P 500 by about 3 times, which is very impressive. And what that's comprised of, it came out of a conversation that Mohnish Pabrai had with Charlie Munger. So Pabrai was kind of mulling about, okay, which pools would I fish in? Which ponds would I fish in if I were trying to create like a set it and forget it strategy for stock picking? And Munger basically said, well, I would look at cannibals, which are companies that are buying back a lot of their own stock. I would look at spinoffs, which tend to be smaller chunks of a company that the company spins off into its own business entity. And there's a lot of reasons that investors who held the original would be forced to sell after a spin-off kind of situation, and that forced selling can reduce the price to the point where it becomes an attractive investment. So spinoffs was the second one, and the third one is shameless cloning. So looking at 13Fs of some of the top investors in the US and seeing what they've been buying recently, and just kind of picking based on that. So those are the 3 kind of pools within the free lunch portfolio, and each year you'd buy 5 kind of in each strategy. And Pabrai, on his blog chaywithpabrai.com, he every year he releases the 5 new picks for each category. So it's really a approach where you buy 15 companies each year, and then the following year you sell the ones that are no longer on the list, and you add the ones that are on the new list to your portfolio. So that did 17% from 2000 to 2017. So that's one way to beat Buffett, who's done 12% over the last 30 years. The second strategy is the magic formula. Ooh, the magic formula. So that's from this book, The Little Book That Beats the Market by Joel Greenblatt. If you haven't heard of Joel Greenblatt, he's a legend in the hedge fund industry. He was generating somewhere around 40% annual returns over, it was about 20 years back in the 80s and 90s. Really impressive stuff. And what he discovered, he did a lot of statistical analysis of different kind of metrics that you would evaluate companies on. And he found that the combination of both earnings yield, which is a measure of how cheap a company is, and return on invested capital, which is a measure of how good a company is if you rank all companies according to their combined score for earnings yield and return on invested capital, he found that if you bought those top companies, the companies that came out on top in that screen each year, if you bought, I think he recommends to buy about 20 each year, and then the next year you would sell the ones that are no longer on the list, and you would replace them with the ones that are on the list. Doing that, so back tested from 1988 to 2009, the magic formula produces 23.8% annual returns, which is pretty impressive. The S&P 500 over that same period returned 9.5%. So really good stuff. It's you can't really compare. I don't have the data to compare the magic formula to the free lunch portfolio. The back tests are over different periods of time, but they're both incredibly impressive when you compare them to the S&P 500. So those are the first two. And the last one, now there was a study published, I believe it was 2008, and it's called Imitation is the Sincerest Form of Flattery. And it was two university professors that looked at, what if you had mimicked Warren Buffett's investments from 1976 to 2006, okay? So a 30-year period where you had mimicked what Warren Buffett bought and sold. And you could see what Warren Buffett is buying and selling through 13F filings. Every quarter, he's required to disclose his U.S. holdings that are, over a certain size in investment. I'm not exactly sure what that is. I know any manager who manages over $100 million in the U.S. is required to fill out a 13F, which shows what they bought and sold in the last quarter. And so, if you could have ridden Warren Buffett's coattails for 30 years, just buy when it's publicly known that he bought something, and sell when it's publicly known that he sold out of that position. That would have given you 24.6% annual return from 1976 to 2006. That's compared to 13.8% from the S&P 500. And it's interesting, the magic formula and cloning Buffett, it's not the same time frame that they're looking at, but it's within 1%, which is kind of interesting. 24.6 and 23.8 for the magic formula. So obviously we can't do this today with Warren Buffett. Maybe that's not obvious. But Buffett himself said, a fat wallet is the enemy of high returns. Now, this is why Buffett is getting 12% per year. When he was starting out, back when he was managing his partnership, I believe it was 1956 to 1969, I think he was well north of 30% annual returns. And Buffett has actually been quoted in saying, at a Berkshire Hathaway annual meeting, if he was managing smaller sums of money, $1 million, $10 million, somewhere in there, he thinks he'd have no problem generating 50% annual returns. So it really is much more difficult for him to generate high returns with the amount of capital that he's managing in Berkshire Hathaway. Oh, don't we feel sorry for Warren? He doesn't feel sorry for himself. He's doing pretty well for himself. But as people with not as much capital, I don't know, maybe you have billions of dollars. That'd be pretty cool. Let me know in the comments. If you're watching this, if you're one of my 528 subscribers and you're managing billions of dollars, that would be interesting to me. But, most of us don't have that issue of having so much capital that we can't, get involved with these higher return opportunities. We're stuck buying American Airlines and Delta and things that Warren Buffett never thought he would buy. So those are the 3 strategy, guys. The free lunch portfolio, check that out at chaywithpabrai.com. And I'll link to it in the description. Number 2, the magic formula. That's really this book. If you want to learn more about that, get this book. The screener, which is free from Greenblatt, is at magicformulainvesting.com. And you just have to give them your email, and then you can sign up for a free account. And then the last one is cloning. So Buffett isn't the guy to clone anymore, but there are plenty of other value investors, investors who, have studied Buffett in much depth, and they manage their money today kind of with a Buffett kind of philosophy. Pabrai is one of those people. And there's actually I think 9 or 10 other managers that Pabrai clones, right? So it's like this kind of stacking Russian doll kind of phenomena. But and I think he did a blog post. I'm sure he did a blog post on Chai with Pabrai about the other fund managers that he really looks at to figure out, who he wants to clone, what ideas are worth looking at. It tends to be managers who manage a concentrated portfolio. If your biggest holding is 4 or 5%, that's not, Pabrai is not interested in that. He's interested in the managers where, their top idea is maybe 20% of the portfolio, and they might have 10 companies in the entire portfolio. So it's really important to have that concentration, have that. You really want to know that it is the manager is quite sure of this bet. So they've put a lot at stake, right? That's kind of, you want them to be putting their money where their mouth is in terms of, okay, they really like this investment because they put a large percentage of their fund worth into it. And there aren't that many big investors who invest that way in a really concentrated way. My understanding is when you're earlier in the game, like back when Buffett was getting started in the 50s, in order to grow wealth, you really want to concentrate it in what you know. Obviously, you want to put the most money into your highest volition ideas, right? Why would you want to dilute your best ideas with, number 10, number 15 down the list? But when you get into these portfolios where the highest, position is 4% of the portfolio, that to me is more of a wealth conservation strategy. Or people who just believe in diversification, which it's hard for me to understand. A fund manager would feel like they need to own 40 companies in order to be diversified. But, that's one way to conserve wealth, is to spread it a lot of different places so that any one, disaster isn't going to impact the portfolio very much. And then you want to make sure the person you're looking to clone has at least a track record of 15 years. Anything less than 15 years. And it's hard to tell if, the returns are largely due to them taking more risk than most other investors, or if it's due to skill. Once the portfolio has been through a few dips, been through a few recessions, crashes, you can start to see, as Buffett says, who's been swimming naked, which are, people who are using leverage or just chasing higher returns by going after riskier assets. So anyway, guys, that's what I wanted to say here. 3 ways to grow your money faster than Warren Buffett. It sounds pretty awesome, and it is really awesome. If you can generate north of 15% annual returns per year without even thinking, just setting it and forgetting it, and every year just following, okay, what's on the list? What do I buy and sell? Boom, boom. It's very simple. Actually, one of the Pabrai actually talked about this in one of his lectures, his guest lectures, that people have a really hard time copying great ideas. And he observed, Tom Peters is actually the guy that Pabrai picked this story up from. And there were two gas stations. I believe it was in California. They were kind of kitty corner at this intersection. And one of the gas station owners, he would come out like every hour, and he would offer to, full service for a customer that came in. He would fill up the gas. He wouldn't pay for the gas, but he would, the customer would sit in the car. He would fill up the gas for him. He would clean the windshield, full service. And he would do that about once every hour. And the owner across the street could see this happening. And, he would think to himself, well, you can't do it for everyone. Why do it for a couple random people, right? But what he noticed is over the weeks, over the months, more and more people started going to the gas station across the street where the owner would do this kind of free full service treatment every hour. And even though the owner across the street could see this happening, he didn't do anything about it. Even when he had the evidence that this was working, okay? And there's something in human psychology where copying great ideas is really difficult for people. So you might look at these 3 different strategies and think, well, how could those possibly work? If those worked, enough people would do them that they wouldn't work anymore. But, it's a quirky thing with human psychology. These things do work. There are people using them, not very many. And because there aren't very many people using them, because there aren't very many people who act on kind of copycat ideas like this, they still work. So, if you're thinking, it sounds too good to be true, well, that could one potential explanation why, it's still working even though, it shouldn't be. Enough people, obviously you'd want to get 24% per year instead of 10%. Like your money grows so much faster at 24% than it does at 10%. Ridiculous, like geometrically, exponentially faster. So, I don't know, guys. If you have any ideas, let me know in the comments why more people aren't following these. There's a lot of people who think, the markets are efficient. You can't beat the market. So another reason. But anyway, it's enough about that. I hope you enjoyed this video. Hit the like button if you did. Hit that subscribe button for more videos about investing and really greater finance in general. All right, guys, have a great day. Take care.